Have you ever heard of the total portfolio approach? It's something that has been taking hold in parts of the world, perhaps over the past 20 years, which helps people invest in a more traditional, maybe a less traditional way, but a more pension based sort of manner where you think about risk, return, and a wider opportunity set of what you can do to build your portfolio. When you make your wealth decisions, you need to think about a wide universe of possible options.
Make Better Wealth Decisions, a podcast that explores how financial advisors' blind spots can harm your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. In this podcast, we'll provide advice on how you can achieve better outcomes by maximizing investments and minimizing taxes. Let's put our thinking caps on as we consciously decide to get smarter about our money.
This week on Make Better Wealth Decisions, we're speaking with Stephen Novakovich, who is a CFA and the managing director for the Chartered Alternative Investment Analysts Association. Stephen, welcome.
Oh, thanks for having me. Delighted to be here.
You're based in the US, and your association does a great deal of work with regard to alternative assets. And we've spoken about alternative assets a fair bit on this podcast over the past number of months. Your approach is useful, in my opinion, because when I talk to other people about alternative assets, they'll say, well, it does this, it improves risk adjusted returns, it plays various roles. But what is interesting when I was listening to you speak when you were in Toronto about a month ago is that you were talking about something called TPA, a total portfolio approach, which is something that I understood intuitively, but I'd never heard anyone else speak about. So I'm wondering if you could perhaps walk us through what TPA actually is.
Sure. Yeah, thanks. Happy to go through that. And it was something that's was really fascinating for me to dive into and learn about. And let me take a step back before we just jump in. But from Kaya's perspective, a lot of what we've historically focused on is institutional investing, institutional investment management, pension plans, sovereign wealth funds, so forth. The reality of it is the world of alternative investments is broadening beyond institutional investors and now making it into the world of high net worth, the retail investors, mass affluent, whatever kind of language you want to use. And so that's been a really great development for the industry and for investors as a whole to be able to have access to more investment options. But then going into TPA, when you think about institutional investment management globally, for decades, there was predominantly one kind of model that fell into place. And here in the US, we might call it colloquially the Yale model, but generally speaking, it would have been known as the endowment model. This was really the first model that embraced and brought alternatives into the forefront of investment portfolios. You saw that really with David Swenson at Yale and in Harvard being really early adopters and bringing in alternatives to being half of the portfolio plus. And then as they were successful, more and more investors sort of quote unquote copied that profile. And you saw pension plans increase their exposure to alts, sovereign wealth funds, family offices, and so forth. Well, 20 years ago or so, quietly, a new model started to take place. And there were really two geographies where we really saw this model, a total portfolio approach, percolate. And that was in Oceania, in Australia and New Zealand, and in Canada. And over the course of the first decade, sort of 2004 to 2014, the development and iteration process. And then in the last decade, it's really matured and become refined and adopted a little bit more broadly. But it's through these last 20 years, it's grown, but rather quietly. And it's not something where you see sort of mass adoption. And we kind of stumbled upon it ourselves here at Kaya and learned about it and go, oh, this thing's been around for a while, but we haven't heard much about it. And we went and did our own research, and there were a couple organizations here or there that had published maybe a report or white paper here or there, but it wasn't part of a broad conversation. And so we started to dig in and learn about it and said, hey, there needs to be more voices amplifying this and talking about it. And so that's where we really thought we could contribute, was to research it more fully and spread the message of what TPA is. And so this is a very long-winded way of saying that TPA is something that's existed for a while, but still is pretty new overall, and still is pretty, the adoption is still pretty low. There's maybe 15 to 25 organizations globally that quote unquote fully adhere to TPA. If you haven't heard of it yourself, there's, I wouldn't be surprised, even if it is something that has been around for a little while.
Okay, so
So
I was going to jump in just to say that I want to see if we can compare and contrast that with the way I was taught and the way my own methodological thinking toward
yeah,
portfolio construction evolved. I've been a financial advisor for over 30 years, and the past 15 or 16, I've been a portfolio manager. And I was brought up on the notion of optimization and modern portfolio theory using the precepts that were pioneered by Harry Markowitz in the 1950s, which
yeah,
is combining asset classes of various risk return attributes with various attributes in such a way that you can either get the maximum return for a given level of risk or think of what you can do in terms of what you can do to increase return for a risk or lower risk for a given level of return. But at any rate, improving risk adjusted returns. But that was done using products that were available in the 1990s, which were largely publicly traded securities. And therefore, the use of alternative assets was not part of that modeling. And it was
yeah,
therefore not part of the teaching that was done. And as you say, the Yale model, the endowment model, is something that has gained credence in lockstep with the past generation or so. But it's the sort of thing that it struck me as new when I heard about it, because even though I understood intuitively, I was quite familiar with what Swenson had done at Yale and what, for instance, Canada Pension Plan Investment Board is doing and what other major endowments are doing. But
yeah,
I never really thought of how we could actually take the work that we had all understood intuitively to the next level by
yeah,
incorporating alternatives in a meaningful way into the model.
yeah. Where to start with that is when we think about what defined TPA or what defines TPA, I should say, is with the endowment model, it's easy to do that one liner, if you will, or an elevator pitch as to what the endowment model is. With the TPA, it was not as easy of an exercise. And to be frank with you, if you go and talk to those 15, 20 groups that employ TPA, they all do it a little differently themselves. So there isn't just necessarily one kind of copy paste type of a model. But what there does exist across all of them that we found were key tenets, or what we call dimensions, that they all embraced and brought into the organization. The first two we can skip over because they're not as much about the portfolio, but I'll just mention them. One of them was about the governance structure of the organizations, and another one was about the culture, which is very important. But the other two are much more about the portfolio, to your point. The first one I'll bring up is the traditional model that you're talking about, the MVO, the mean variance optimization model. You've got your asset classes, you've got equities, you've got bonds, you've got hedge funds, you've got venture capital, whatever. You put those in, you have your risk return estimates, your correlation matrices, you put them in, shake it up, efficient frontier, there you go. There's nothing wrong with that. But one of the challenges is in the world of alts, well, there's a couple things. Number one, the world of alts is constantly changing and evolving and growing. If you think about hedge funds, 30 years ago, there's far fewer hedge fund strategies than they are today. So when I say, hey, let's have an allocation to hedge funds, what does that even mean? Hedge funds is a legal entity. What is the risk return profile for hedge funds? That's a really impossible answer. Similarly, real estate, you might say, oh, it's a lot easier to define real estate. Let me just say this: core real estate is a very lower risk, income oriented asset that's going to have kind of a really much more muted risk return profile. On the other end of the spectrum, opportunistic real estate has zero income, much higher volatility, and a much higher return target. So just to even use the term real estate may not be very descriptive depending on what strategy you're employing. And so what the folks with TPA recognized is we can't use asset classes as our structure. We can't say, let's put in our model, we want to do X% in real estate and Y% in hedge funds, because that doesn't tell us anything. It doesn't actually tell, we're ignoring the underlying exposures. And so all of the TPA folks operate with what we call a factor lens, where they really try to do a look through and say, what exposures am I actually getting? And the factor analysis could be very complex or it could be very kind of simplistic. Some of them just simply said, I'm going to break everything down into equity risk, credit risk, and illiquidity risk. Others, some of our friends up in Canada, have factor lenses that include 40 plus different factors that they're going to look at. But then what it is with each investment that you make, all right, I'm making this real estate investment. what is the amount of equity exposure that this real estate investment is bringing? What is the amount of credit exposure that this real estate investment is bringing? What is the illiquidity that's being brought by this exposure? And that way, then when you build your models and you build your portfolio, you can truly understand the drivers, the sensitivities, and the exposures that you're getting with these investments, rather than just saying, hey, I have 20% real estate. Because the reality of it is that doesn't actually tell you what your risks are in profile. So that was a
So what
really big,
Yeah, so what I'm hearing you say is you can dial up and down the exposures to various factors, small cap, large cap, value growth, and credit going long and short on the yield
yeah,
curve and government debt versus private debt and so
yeah,
forth. You really need to look under the hood and not just give it a label, but actually look at the underlying parameters associated with each of the constituent parts of the salad that make up of the individual things that make up the entire salad. My assumption, therefore, is that by using other things that are more customizable, more discrete, and simply more of them, is that it leads to portfolios that would have a better expected risk adjusted return, which is to say it should, at least in theory, extend the frontier upward and to the left, where you get either less risk or more return, or maybe a little bit of both compared to what was available in the data set and the opportunity set before using a total portfolio approach. Is that fair?
yeah. I think that's very fair. The fact is, you are having more refinement about understanding your risk and your risk exposures. And so that means you can do a better job of optimizing that within your portfolio. And that could be that you're talking about optimizing your drawdown risk. It could be you're just optimizing your volatility. But being, to your point, when you know what's in your portfolio more completely, you are making a more robust portfolio from a risk return profile.
Okay, so let's see if we can break this down for the people listening at home. What would you say are the main takeaways or the main benefits? If you're going to look at portfolios through a total portfolio approach, what should you expect? What would you expect to gain? Or what you should be looking for if you're
Yeah.
speaking with someone who's espousing using that approach?
Yeah. So I think that another thing to point out then is that, again, you're looking at the portfolio holistically. For institutional investors, this might be a bigger point of emphasis because a lot of times institutional investors they're organized and structured by teams. You've got your hedge fund team, you've got your private equity team, and so forth. And then that's with the endowment model, really. With the TPA model, you really try to break down those barriers and just think about the portfolio as a whole. Now, with your wealth manager, you're probably a team of one or so forth. You're not really organizing your investment decision making around these strategies. But irrespective, one of the things that's super important is okay, you're always putting a new investment in, which means you may be taking an investment out. And let's go back to that real estate example. If I'm making a core real estate investment and it's a new core real estate investment, well, I need to generate that cash from somewhere. Where is that cash coming from? Well, if it's a core real estate investment, well, core real estate is going to be much more income oriented, fixed income like. So what you're going to want to do is you're going to want to probably take some of that cash from fixed income portions of your portfolio. But if you're doing a more of an opportunistic real estate investment, well, that's going to be much more equity like. So, in this situation, you wouldn't want to take cash from the fixed income portion of your portfolio. Instead, you're going to get cash by selling down some stocks because you want to make sure that what's coming in looks like what's going out so you can
Right.
maintain that risk exposure profile. If you don't do that, suddenly you could say, oh, look, I've added real estate to my portfolio and now I've got more income and more low risk in my portfolio because I've got a 10% allocation of risk to real estate. Well, if that's not core real estate, you're diluting yourself and you may
Right.
now actually have a higher risk portfolio than intended. So I think that's one of the most important things is from a holistic standpoint, one of the things you can be more mindful of is when you are adding investments, thinking about what profile that's bringing, and then saying, where am I going to then take cash from to bring this in and make sure that you have that like to like match. The level of sophistication is up to you. You don't have to do, you mentioned some really classic factors, small cap, geography, so forth, momentum, value, growth, interest rate sensitivity. If those are important things for you or your client, you should measure them and monitor them. If interest rate sensitivity isn't something that's a relevant or meaningful thing to track, that's fine. It could just be the case that you just need to track equity risk and credit risk and liquidity. So it's kind of the level of sophistication or the level of look through that you do is really predicated on what your needs are, what your client's needs are. But at the end of the day, at a minimum, we recommend equity, credit, and the liquidity risk. And therefore, when you make new investments, you're matching those exposures and you're optimizing around those exposures in your portfolio, and you have clarity as to what those exposures look like across all the investments that you're making.
So let's see if we can talk about how this total portfolio approach has changed the way people do business. What would you say has been the impact of the total portfolio approach in the wealth management industry since it's become adopted as a more of a mainstream consideration?
So obviously one of the questions people want to know is, why should I do this, or what impact will it have on returns, right? And I want to be very careful about this because it's a small sample size in terms of the number of organizations that have adopted it, and arguably a small amount of time as well, 20 years, if you will. But
Mhm.
that being said, if you do an analysis of the firms that have utilized TPA for 10 plus years, what we found was that the impact on their return profile was anywhere from 0.5% to 2% per year overall in terms of performance. So
Holding
positive.
risk and variability, standard deviation constant.
Yes, that's exactly right. And so I think, to your point, where is this performance impact coming from? I think it's two things. Number one, you're doing a better job of optimizing your risk, right? So if you're aware of your risk profile, you're going to go into the securities that are going to maximize your return given a certain risk. I think that's number one. And then number two, the last dimension that we found that existed that I haven't mentioned yet was this concept we call competition for capital. The idea of being really thoughtful about what you're bringing in is the best idea for the overall portfolio at any given time. And to sort of give that a little bit more teeth and understanding, when you go through the MVO process, that asset allocation process, what the output is 20% in hedge funds, 60% in equities, 10% in real estate, and so forth. And you have these targets that you need to adhere to and build towards. Well, what if in the current moment you're at 8% to your hedge fund weight, and you need to get to 10%? But what if the opportunity set in hedge funds isn't the best at that given time? Why force an allocation if there's better opportunities in a real estate investment or an energy investment or an equity investment? And so I'm not saying that means you throw your asset allocation away, but that you really ask yourself, is this the best thing for me to invest in right now? I could invest in this hedge fund strategy that gives me a certain amount of equity and credit exposure, or I could go invest in this real estate investment that gives me a similar amount of equity and credit exposure, but at the moment has a better projected return profile. And so again, if you get rid of those walls and those artificial like buckets of I need to have X% hedge funds, instead just say, okay, my portfolio needs to have a profile that is, I'll make it up, 70/30 equity credit, but you don't structure it where it's got that 70% equity must be actually public equities, but can come from any
Right.
investment that provides equity like exposure. Then you can really say, okay, I'm looking at this hedge fund right now, but I'm also looking at this real estate investment. And this real estate investment is going to give me a similar exposure, but with a better return profile. And so that competition for capital mindset is really important for TPA folks too, of looking across the universe and saying, what is this? What is the best way for me to get this exposure right now? What's going to be the best investment for my portfolio today? Not just something that's going to fill a bucket.
It sounds to me like the TPA approach is perhaps a little less lavish about target allocations than a more traditional approach. So if a traditional approach is, let's say, 70/30, to use your example, oftentimes you might have, say, a 10% variance. So you could have anywhere between 60 and 80% exposure to equities, and you're still on side, and anything between 20 and 40% to income slash credit, and you're still on side. It sounds to me what I'm hearing you say that if you broaden the universe of the way you slice and dice and become more granular, you can also be a little more flexible with regard to the weightings that you assign if there are better opportunity sets, better options in the opportunity set that might not fit neatly into one of those two buckets. Is that fair?
I think there's two answers to that question. The first answer I'd give is that when we say like 70/30, right? Well, I guess in the institutional world, it wouldn't be 70/30. It would be 20 to the hedge funds and 15 to private equity and 10 to real estate and 30 to public equities and 20 to fixed income, blah, blah, blah. And you'd have 10 different buckets. With TPA, it's you have two factors and everything just rolls into it. And you don't have to worry about how much is in real estate versus private equity versus hedge funds and so forth and what's underneath. there's no rigidity around it. So there's lots
Right.
of flexibility underneath the surface. You're always going to, not always, you're going to, the roll up is always going to target that 70/30, but how you get there can be highly variable. That flexibility of getting to 70/30 exists in TPA that might not exist in the traditional world, because there's a lot more, I need to get this bucket to this level. Now, to the second part of the answer to your question is actually yes. When we talk to TPA folks, they may have a 70/30 target for the long term, but then in the short term, they might say, oh, I need to be 50/50 right now, or I want to be even 30/70 right now. And they can make more dramatic changes in their portfolio. Now, not every single TPA firm felt compelled to do that, but there was more opportunity for flexibility and openness to more kind of tactical changes to portfolios by TPA adherence. And so some of the plans in Canada really exhibited that greatly. I'll give one example. One of the Canadian pension plans that I'll leave unnamed, but they came out when interest rates were near zero. They said, why would we have fixed income in our portfolio?
Right.
And they literally took their fixed income exposure to zero for 2 years.
Right.
It's
Just setting yourself up for what was going to be carnage, because literally rates cannot go lower.
Yeah.
And it's a question of when they're going to go higher, but
Yeah.
not if.
And so
And,
that was
and
very impactful for the portfolio, but that was a huge allocation, right? And they made that change. Would other traditional institutional investors have had comfort in doing something like that? Because it would have been a massive change. Because to your point, normally it's like you got this 10% band plus or minus. This was a big change. The answer
right.
would probably be very few institutional investors in the traditional model would have had the comfort or willingness or tolerance or even remit to do that. In the TPA world, there is that culture that allows you to do that if you have the conviction to do so. And not everyone wants to, and not everyone will, but there are TPA firms that do. The last thing I want to say about it though is I'm not talking about like day trading. I'm not talking about 1 month changes to
Now, yes.
portfolios. When we talked with these folks, it might be one, maybe two times a year where something comes up where you do go outside of your structure, and then you make that change, and it might be a 6 month tactical decision. It might be a 9 month tactical decision. It might be 2 years at most. So it's not too often, and it's not a short time frame, but it's also not the same thing as doing a big long-term strategic shift in the portfolio either. So it's that 6 month to 2 year kind of opportunistic decision making.
So, out of curiosity, as we record this at the end of 2024, how many of the people that you're working with that are employing a TPA approach are lightening up on their exposure to US equity as a direct result of valuations being at nosebleed levels for the S&P 500 and NASDAQ, and specifically the Mag 7? If you look at it based on the Buffett ratio, it's at an all-time high. If you look at it based on Bob Shiller's CAPE ratio, it's maybe the second highest, only behind the dot-com bubble. Any way you look at it, the US market is really expensive. And some people, as you mentioned, if they have an investment policy statement, they're slavish in their commitment to their percentage allocations because that's required and codified. But if you're a true fiduciary and you're trying to improve risk adjusted returns, you shouldn't feel compelled to be exposed to a certain asset class that you know is going to be, as the example you used a few moments ago about bonds when rates were at zero and certain to go up. Why would you feel compelled to have to be exposed to something when the short to medium term outlook is really quite troubling?
I think that's a really great point and a really good example of, all right, you have equity exposure, you want to maintain equity exposure, but your outlook for US equities may not be particularly positive. Well, you can get that equity exposure elsewhere in your portfolio. You can have buyout strategies that provide equity exposure. Like I've already mentioned, real estate strategies can provide equity exposure if you go into the kind of higher risk, opportunistic real estate investments, so on and so forth. The answer is yes. When you talk with other TPA folks right now, and they put together their, if you will, their capital market expectations for the year, or are looking at the opportunity set. If the S&P 500 is at stretched valuations and your forward-looking forecasts aren't that high, that competition for capital mindset says, all right, well, that marginal opportunistic real estate investment I'm looking at right now looks better to me than the S&P 500. And so if I'm going to invest in this real estate investment, that cash can come from selling down my S&P 500 exposure. So I think that's a really good example of TPA in action, where you can find exposures elsewhere and then use capital from the stretched valuation spot to fund the more attractive opportunities that are giving you a similar exposure profile.
Thank you, Steve. That's been, I think, a really helpful summary of what TPA is all about. And I've really enjoyed it. And as I say, it's been good listening to you speak, because it's something that I think is intellectually intuitive, but has not been actively pursued within the practitioner community. So I want to thank you for helping to pioneer the acceptance of a total portfolio approach. Last words for you. What advice would you give people to help them make better wealth decisions?
Yeah. So one quick thing, and then I'll answer that question. What we've been telling people about TPA is that you don't have to, it's not all or nothing. Understand the different elements from it, figure out what might work for you and your organization, your client. And some things you may feel really could be beneficial, whereas others maybe are not as appealing or so forth. So there is a bit of, you can, if you will, menu and pick and choose, and you might find something is iterative and improving. And that connects to your questions in my mind is, what can wealth people do to improve their portfolio? The more you have insight in terms of what you truly have in your portfolio and you're investing in, the better served you're going to be. And I think that's something that TPA does really well, is it really creates a better lens in terms of giving you that kind of clarity and look through in terms of what actually you have in your portfolio and the exposures that you have. And you have to know what you're investing in. You have to know what sensitivities are that's associated with it and what's going to make it move. And when you know what you're invested in, what risks you have, and what's ultimately going to be a driver for your portfolio, and you can focus in on the ones that you want to have and try to remove the things that you don't want to have exposures to. So that's what I think is really impactful, important for folks, is understand what's in your portfolio and have that stuff in there with intentionality, as opposed to just unintended risks.
Thank you so much, Steve. It's been a real pleasure speaking with you today. I want to wish you all the best in the new year.
Thank you so much. It was great to be here, and happy investing, everybody.
John DeGuy is a portfolio manager with Design Securities in Toronto. The views expressed in this program are not to be construed as specific advice. It is recommended that you consult a qualified advisor before taking action. His books, The Professional Financial Advisor 4, Stand Up to the Financial Services Industry, and Bullshift are available through Amazon and in bookstores throughout Canada. You can reach John at 647-STAND-UP. That's 647-782-6387, or at jdeguy@designedsecurities.ca.